Welcome to this episode of The Joshua Dean Show.
Hello and welcome to The Joshua Dean Show. I'm your host, Joshua Dean. Under the Attorney Review video series on this website, I put together a couple of videos detailing the buyer's and seller's closing costs. As one of the biggest expenses that a seller will have when selling a home, and with so many sellers getting themselves upside down when they get to closing, meaning they have to pay money in order to close instead of making money, I thought I would put together an episode which will better explain real estate taxes, show how they're determined, and then show you a couple ways that you can avoid getting yourself upside down, and a number of ways that you can help reduce your own taxes. So let's begin. Real estate taxes are paid in arrears, or 1 year behind. Most real estate taxes in Illinois are going to need to be paid in June and September. Real estate taxes are made up from a number of different taxing bodies that service the area that the home is located in. For example, Naperville Township includes parts of the cities of Naperville, Aurora, Warrenville, and the town of Eola. There are a number of taxing bodies that make up this township, including DuPage County, the DuPage County Forest Preserve, DuPage Airport Authority, the College of DuPage, Naperville Township Highway, Naperville Township, the city of Aurora, Warrenville, and Naperville, the Naperville and Fox Valley Park District, the city of Aurora and the city of Naperville Library Systems, and Unit School District 203 and 204. All of these taxing bodies must create a budget every year, which will itemize the expenses that they expect to have for the upcoming year. Once all of these taxing bodies submit their budget, the amount that needs to be raised in order to support the taxing bodies is determined and then sent to the county clerk. The county clerk will help determine the tax rate which will be applied equally to all taxable properties. To determine your taxes, the township assessor will determine the value of a property based on similar properties in a particular area. Once the value of a home is determined, Illinois law requires that all property in Illinois, except for Cook County, be assessed at 1/3 of their market value. For example, if a home would sell for $330,000 on the market, the assessed value that the assessor will give that home would be $110,000. It would then be this $110,000 which would be multiplied by that area's tax rate, which would determine the amount of taxes for that property. There are, however, a few ways to help reduce the assessed value, which means you'll pay less in taxes. These are known as property exemptions. The first is the residential exemption, which reduces your home's assessed value by $5,000. In most cases, this exemption is automatically applied to your tax bill, and you don't need to do anything to file for it. The second is the home improvement exemption. If you make a property improvement, such as adding a pool or a deck or finishing your basement, the value of your home is going to go up. In order to not have your taxes go up based on your new improvement, you'll want to make sure you file for this exemption. This tax break exempts up to $75,000 in market value for your improvement and will not be added or assessed to your value of the home for 4 years. If you're a senior over 65, you can file a senior citizen's homestead exemption, and in DuPage County, it will reduce your assessed value by an additional $3,500. And if you are over the age of 65 and have a total household income of less than $50,000, you can apply for a tax freeze. So as property values increase and taxes go up for everyone else in the county, your taxes remain frozen. For most people that buy a home, the taxes are already escrowed into the buyer's mortgage payment. This simply means that your taxes have already been estimated, and each month a portion of your mortgage payment goes into a separate account that your lender has set up in order to pay for your taxes when they become due in June and September. If you are selling a home, you will be responsible for paying any unpaid taxes from the year or years before, as well as the current year's taxes. So if you have a closing on July 7th, 2007, you would have likely already paid your first installment of 2006 taxes since they were due in June. Since your second installment of 2006 tax bill isn't due until September, when you close on July 7th, you'll be responsible for paying that second installment from 2006 taxes and for the period of time in 2007 that you've lived in the home. Thus, you'll have to pay taxes from January 1st, 2007 through July 7th, 2007, because next year, the buyer that's purchasing your home will get the tax bill for the period of time that you've lived in the property in 2007. Although your taxes may be escrowed, you as a seller still need to pay those prorated taxes at closing. Once you close on your home, your mortgage company will send a check to you for the amount that's in your tax escrow, and that's accumulated over that period of time. This can take between 2 to 5 weeks after the closing of your home to get that money. So while you will likely still get a good portion of the tax money back from your escrow account, you'll still need to pay that amount at closing. Now, there are a number of reasons why sellers get themselves upside down. And remember, being upside down simply means that the seller is making no profit on their home and instead has to pay money in order to cover all the expenses of selling the home. For some of the reasons that a seller gets themselves upside down could include not having any equity built up in the home, selling within the first year of buying a home and likely having 100% financing loan on the property, taking out a second home equity line of credit and tapping out your equity, overloading yourself with too much debt after you close on your home, and a number of other reasons which certainly happen all the time. When I or one of my agents first meet with you at our initial listing appointment, we're going to give you a worksheet which will help you determine your approximate closing costs. I always make one suggestion to my clients at this time. Call your mortgage company and order a final payoff for your mortgage or mortgages and tell them to determine your payoff from 30 to 90 days from the date that you order it. They will then send you a statement which will give you the principal amount you owe as well as any interest through that date. Since mortgage interest is also paid in arrears, you'll also likely have to make sure that you add your final month of interest into your payment. This is also assuming that you've made all your payments on time and have no delinquencies. Once you determine what your final mortgage payoff will be, then we can help you determine your remaining closing costs. If you're going to be upside down though, there are a number of recommendations that we can help you make, depending on your situation, which can reduce the amount that you will owe and potentially get you back to the break-even point and potentially even make a small profit. Our goal, of course, is to market your home effectively, sell it for the most amount of money, and in the shortest amount of time possible. When you work with Joshua Dean Real Estate, you're going to have all the information up front so you can make the best and most informed decision about selling your home. I don't like surprises, and I'm sure you don't either. Now that you have an idea of how your taxes are determined and how your taxes get paid at closing, I hope you'll give us a call if you're considering selling your home so we can not only show you how we're going to effectively market your home, but also prepare you for the costs involved in doing so. On behalf of Joshua Dean Real Estate, I'm Joshua Dean, and I thank you for watching this episode of The Joshua Dean Show.